Buying a home is one of the biggest financial decisions you'll ever make. And today, there's a new trend gaining attention: the ultra long term mortgage, 40 years, 50 years, instead of your typical 30-year fixed. But what you might not hear is that the longer term may benefit the bank more than you. Let's break this down. Here's a comparison. Suppose you're borrowing $400,000. Just as an example, if you choose a 30-year fixed rate mortgage, you'll have the benefit of paying off the principal in 30 years or 360 months. You build equity faster and you'll own the home outright sooner. Now, let's contrast that with a 50-year term. It spreads the payments over 600 months. Dang! That sounds appealing because the monthly payments will be lower, but there's a huge trade-off. First, it's going to be the interest. Many assume that because the monthly payment is lower than for a 50-year term, they're winning. But in fact, the longer term means more total interest paid, often dramatically more, and guess who? To the bank. One breakdown shows that even a given interest rate, a 50-year mortgage can almost double the amount of interest you paid compared to a 30-year term. Also, lenders will probably charge you behind a higher interest for the 50-year term because they're taking more risk and there are more regulatory complications. For example, one source says that a 30-year mortgage at 6.32%, a 50-year version might be 6.8% or even higher. So you're paying lower monthly, but you're paying much more total interest over time. This can't be right. This has got to be a big joke. And here's the thing. This structure tilts the advantage towards the bank or whoever holds the loan. Why? Because a longer term means more months during which interest accrues. The lender collects more interest over the life of the loan. It also delays when you actually build meaningful equity in your home. We'll cover equity in a moment, of course, if you're asking what it is. You stretch those payments out for more than 50 years, and you more than likely have a job change, health issues, life events, or something that's going to change your life where you can't consistently make those payments. It sounds like you're getting more of an affordable payment today, but you're handing a bank a long, stable revenue stream at your expense. This is why we need this conversation. Equity is basically when you truly own in your home. Like, what's the actual difference between what your home is worth and what you still owe to the mortgage? There are two ways that equity grows. First, by paying down the principal. As you make your mortgage payments, that part that goes towards the principal increases over time. In the early years, especially in long-term loans, most of your payment goes towards interest. Second, there's an appreciation of your house value. So if your house goes up in price, that naturally increases your equity. But with a 50-year term, things change a whole bit. Your monthly payments are lower, so less of the payment goes towards your principal in those early years. And I mean kind of a long time, all right? And that means the equity builds up a lot more slower than it does in a 30-year. The longer the term also means you'll be paying more interest for many, many more years before you actually are free and clear and own that home. So if you end up selling early, you might not have built up enough equity to make a meaningful profit, and honestly, you could still owe a lot more in interest. So let's talk about selling. Most experts say that you should expect to wait at least 5 years and often even longer to build enough equity and offset the cost of buying and selling, like closing costs, commission, and taxes, so you genuinely walk away with a profit. With a 30-year mortgage, your equity trajectory is faster, meaning you'll be able to sell that profitably sooner, assuming the home goes up in value. But with a 50-year mortgage, the slower equity buildup means you might stay a lot longer, 10 to 15 or even 20 years for the same outcome. If you sell too early under a 50-year term, you could be left holding the bag with little equity and owe even more than the home's appreciated amount, especially if home values stagnate or decline. Think about this. Before you sign up for a 50-year mortgage, you need to ask yourself, do I expect to stay in this home for a very long time? Because the longer the term, the longer I have to stay to make it worthwhile. Is my monthly budget strong enough that I could afford a shorter term mortgage, that is, because I'm choosing a longer term just to lower my payment? If you are, that's dangerous. What happens if I move or sell in 7 to 9 years? Will I have enough equity? Will it basically be starting back over at square one? Can you refinance into a 30-year mortgage or a shorter term if the interest rate drops? Or in your income, will it continue to rise? These are questions you got to ask yourself. The point is, a lower monthly payment might feel like a relief, but in the long-term risk, they are significant. Here's the bottom line. A 50-year mortgage can feel like an affordable way into the housing market, but make no mistake, You are trading a large amount of future interest and delayed equity buildup so that if you pay less each month, that's going to be an issue. The benefits of the lender. There's another one. It doesn't really do you any favors unless you're extremely confident in your long-term stay in the home and your financial stability. If your goal is building wealth, generational equity, and being financially free sooner, then a 30-year mortgage, even shorter mortgage, often makes more sense. So before you commit, run them numbers. Ask yourself, how long are you going to stay? How much equity do you need? Or whether long-term costs can actually be worth the short-term relief. If you like help, including modeling different mortgage term scenarios, drop a comment and reach out. We got family members that are realtors and can help you out with making a decision to protect your future. Thanks for watching, folks. And remember, it's not about monthly payments. It's about a lifetime cost. So you need to choose wisely. If you're interested in starting off real estate by owning land, stay tuned and watch, because I'll show you how you can own land from Ancestry Lands. I'm Phil Davis. Don't forget to like, share, and subscribe, folks. We'll talk to you soon. Bye-bye. That's it, folks. You can go to Ancestry Lands to start owning property today with payments starting at $250 a month, no credit checks, and owning land has never been easier. It's time to build your land portfolio one property at a time. We help you to get dollars from dirt and build generational wealth by owning small plots of affordable vacant land. Contact us to learn more. Oh, and speaking of dollars from dirt, I also wrote a book about investing in land for you readers out there. My book, Getting Dollars from Dirt, A Beginner's Guide to Vacant Land Investing, is on Amazon. The link is in the description section below. Inside, you'll learn simple, easy to read insights that will have you understanding why you should own land today. For more tips and tricks, subscribe for updates, comment below, and let us know what you enjoyed about this video. Thanks for watching, and I'll see you in the next one.
And remember, like and subscribe.